Welcome, and thank you for tuning in. You're listening to the Beyond 50 radio program. I'm Daniel Davis. Back on the program today is a special guest who joined us last time to be able to educate people on how they can become better people when it comes to getting their savings and their retirement on the right track. Now, most people listening to the program today would think, well, we just came out of a recession. I don't have any money left. What do I do now? Or perhaps you're thinking, I'm too old to get anything going that's going to make any significant difference. Well, you might want to know that our guest joining us today has more than 20 years of experience actually advising, being a consultant, if you will, with more than 40,000 financial advisors. Our guest has also investigated more than 450 financial products and strategies and has concluded that Americans are being brainwashed into accepting they have to risk their money in order to grow it. Well, more than 500,000 people here in America are using the method she talks about to achieve predictable savings, growth, and financial security, as well as self-sufficiency. I'd like to welcome to the program today our guest and author of the book, The Bank on Yourself Revolution, our guest, Pamela Yellen. Pamela, thank you for being back on the program today.
It's my pleasure, Daniel, and thank you for having me.
You know, it's really exciting because we've had another guest that we've now done 2 shows with, and he's been a lot of fun and very insightful, just like you have, about different ways of going out there into the market, getting away from what news and companies tell us what we should be doing, with our money, especially the government itself. And so what I'd like you to do, first of all, is let's talk about what Bank on Yourself is specifically.
Sure. When I came up with the phrase bank on yourself, I was looking at it as having multiple meanings. But, you think about the phrase, people say, you can bank on yourself. You can always count on yourself. And so that really is the basis of the financial strategies that I've reviewed and investigated, is which ones really allow you to have control of your finances and your money, and where you do feel that you've taken control of things and you don't feel like you're a puppet on a string, with the strings being pulled by the government, your employer, your 401k, the bankers that make you pledge your firstborn and bring in 3 years of taxes to get.
No, they're going after generations now. They don't care about your firstborn.
You're right. You're absolutely right. So that's where the bank on yourself idea comes from. So it is about strategies that do allow you to be in control, be the one calling the shots. It allows you to bypass Wall Street. It allows you to fire your banker and your credit card companies, and to not have to deal with government-sponsored and government-controlled retirement accounts such as 401ks and IRAs, 403bs, etc., where there really are so many strings attached. It is they're more than a puppet. And when it comes time to wanting to take money from your plan, maybe you have an emergency and you need to have some money, you find out, oh no, there are all kinds of rules and restrictions. And if you go afoul of any of them, you've got taxes to pay, you've got penalties to pay, and some of them you just can't do at all.
Right. I remember a friend of mine years and years ago when I was still in the hospitality industry, and he moved from one hotel to the next. And he was in an IRA, and he ended up having to pull out and roll over. I think it was something, I can't even really remember the neighborhood it was, but it was a significant amount of money. And he ended up being penalized $35,000 just because he was changing jobs. And I thought, why would anybody invest in something as stupid as that, where you end up paying taxes just because you need to move your money from point A to point B?
Well, that's a great question, and the reason that people do it, and most people do it, whether it's a 401k or an IRA, because they, as you in your introduction, you said, people have been brainwashed. They think this is the only thing, the only option that's available to them, and everybody's doing it. And if the government says it's okay and your employer is offering it, well, it must be okay. And you should be a sheep going off to the slaughter like everyone else. But here's the thing, it's like your friend, they don't find out just how bad it is until it's too late. Now their money's locked up in the plan. It's like giving it to the prison warden throws away the key, and you're stuck. You're begging you have to beg for permission for your own money. That is wrong.
Mm-hmm. Here's another thing also to consider, too, as we talk about this particular scenario. 401ks, IRAs. You talk about in your book, and to me, I've thought about this for years. That's why I've never invested in them. For one thing, is we're just now talking about the control the government has. They tell you when you can pull it out, if you can borrow the money, how much. If you roll it over, it's going to cost you in capital gains. I mean, so you can already see 3 reasons why you wouldn't do this. But here's a 4th one that we've all heard of. We've all seen it happen. And we went, well, better them than me. And that is the idea the 401 and IRAs are set up to benefit and protect employers. Now, people might scratch their head and say, well, wait a minute, what do you mean by that? Well, let's take a look at Social Security. Wasn't that originally supposed to be a benefit, knowing that Americans probably won't save money? So the government in their wisdom says, well, we're going to pull out a little bit each month from your pay, and that way you'll have something, when it's time to retire. Well, what happened with that? See, do you see the similarities there?
I do.
So let's talk about that.
You make a great point, and I want to go back to what you said, because people may not realize that when you said that these plans were actually, especially the 401k, they were set up to benefit and protect the employees, and the reality is that they were actually there are no protections, virtually no protections for employees in 401ks. The protections are for the employer, and that was passed. The law was passed in the Pension Protection Act of, I forget what year it was, but that was the law that said that if an employer mismanages your money, puts it in mutual funds with excessively high fees and extreme volatility, that you cannot hold your employer responsible for that. He or she could lose all your money. He could lose half of it. You don't have recourse. That is what the law said.
And does anybody remember Enron?
Yeah.
There's the perfect example where we've painted everybody into the corner to say, wake up, this is exactly what happened there.
Well, yeah, there's so many ways in which this can go wrong, and people forget. Here's the thing. I've studied behavioral finance a lot, and that's how people psychologically deal with money. And what they found out is that human beings have an immense capacity for forgetting the bad and remembering only the good, which is why if you even say a fact to people like, do you know that Wall Street's lost more than half of your money twice just since the year 2000? They would go, oh, really? Oh, I didn't remember that. It was that much? And it happened twice? In 18
Unless
years?
you're a poker player. It's like, what is it in the movie, I think, Rounders, he says, most people can't remember the big wins they've had, but they certainly remember the big losses. So.
Yep. Yeah. So that's the problem. They tend to hold on to the best, and they tend to focus on, but look at how much my accounts increased in the last few years since the last crash. But they forget that all bull markets end in crashes. Historically, there's no exceptions to that. Why would there be an exception this time?
So now that we've talked about that specific scenario here, now what would you say would be a different way that our people listening today can think about doing that you talk about in your book? Well,
I really think it's important to diversify beyond your traditional, and especially traditional government-controlled savings plans. And I think you also have to look at the tax consequences. One of the reasons people love their 401ks, and of course they love the employer match, but that's a scam, and I can get into that if you want. But they also really love the idea that they can defer their taxes. And they don't even think of it as deferring them. They just think, well, I get to put, my entire contribution that I'm making goes to work for me immediately. And so then they kind of tend to forget that at the end, when they go to take money out of the plan, they're going to have to pay taxes at it. But the question I like to ask people is, what direction do you think tax rates are going to go over the long haul? I bet I know the answer you're going to say, Daniel. What would you say?
As far as over the long haul,
the
taxes, obviously, you're going to end up paying more taxes because the tax rate probably most likely will be a heck of a lot higher.
Yeah, and for obvious reasons. We have far few people contributing to Social Security, more people taking from it. We have an aging demographic, and we have a government that's massively in debt. So it's like logical that the tax rates are going to be higher long term. So by deferring your taxes, it's like avoiding a visit to the dentist. All you are doing, if you're successful in growing your money, then you're simply going to end up paying higher taxes on a bigger number, and you're going to lose. Even if that doesn't happen, just if tax rates stay the same, you're going to end up paying out about a third. On average, 1/3 of the money that you take out of your plan when you retire is going to go to taxes. So maybe you think, or you're planning on, let's just take $50,000 a year from your plan in retirement, or $100,000 a year from your plan in retirement. Imagine if you have to cut that by at least 1/3, and that's assuming tax rates don't go up, before you can actually spend it. What's left? A lot less than you thought was going to be left. A lot less.
Right.
So we look at things that allow you to, have control, have predictability. I think the predictability is so important. I think you really need to be able to know what's the minimum guaranteed value of my nest egg when I'm ready to tap into it. If you ask people who save in a 401k or an IRA or a stock market account, can you tell me how much your account's going to be worth on the day you want to tap into it? They have no clue.
Right.
They have no clue.
Mm-hmm.
So how much financial security do you have when you have no clue? You really don't know how much income you're going to be able to take in retirement. You're hoping you have a certain amount, but no guarantee at all. If the market tanks shortly before or shortly after your retirement, you're sunk. You may never recover from that because you're going to be drawing down a much smaller amount much too quickly. So we look at things that are predictable, we look at things that give you control, and we look at things that allow you to take a tax-free income in retirement. In other words, pay your taxes now because you know what they are.
Mm-hmm.
You have no clue. So one of my favorite strategies, financial vehicles, if you will, is using specially designed dividend-paying whole life insurance policies to supplement your retirement income. And these are not the kind that most financial advisors know about, because the ones that they talk about, and they always put them down. A whole life, you can't buy that. That's the worst thing you can do with your money. You hear that all the time. And they're talking about a different kind of policy than I talk about either in my book on the Bank on Yourself Revolution or on my website, bankonyourself.com. I talk about a completely different type of policy, and I prove it on that website that this is not the one that most advisors and experts know about. It has options added to it that increase the growth of your cash value substantially and pay a lot less, 50 to 70% less commission to the advisor, to the insurance agent. So that goes to you and the growth in your policy instead. And it gives you predictability. We were talking about that's one of the requirements. You want predictability. You will know the guaranteed minimum value of the account, the plan, on the day you plan to retire and at any step along the way, because you have guaranteed annual growth, and you have the potential for dividends on top of that. And now these dividends that the companies pay are not guaranteed. You're not guaranteed to get them. However, there are companies that have paid dividends every single year, including during the Great Depression, for 160 years or more. So you have greater upside potential, virtually guaranteed, than just the the basic guarantee that you're given of the annual increase that you're going to get. And these policies, again, they've never had a losing year, not in 160 years. So it gives you a lot of peace of mind. And it also gives you the ability to access the money in the plan without having to fill out an application, pledge your firstborn or your entire generations. You don't have to bring in tax returns. You simply request the money, and the only questions the company asks you are, how much do you want, and where do you want it sent? Which is pretty amazing. But, Daniel, these policies help many, many Americans get through the last financial crisis and other financial crises over the last 160 years, including the Great Depression. They've helped them get through because when no one else could get access to capital, they were able to take it out of their policies.
Mm-hmm. I wanted to bring up something if I could, Pamela.
Sure.
Now, as a radio show host, a lot of times I get to interview really wonderful people about different things. And the flaw that I've found in radio sometimes, and this also includes television, is that you have hosts that have a nice fan base, and I think I've got a pretty significant one myself. But I really like to find the truth in things. Now, that being said, a lot of times I find a lot of recklessness from hosts out there that are misguiding people who listen. And unfortunately, these people really follow them devotedly without doing their homework. And one thing I always say is don't just buy what we're saying here today. Go out there and do your dadgum homework. Do it. Now, that being said, there's there's actually a couple of people, and I like their intention in the beginning, but I'm beginning to see a real flaw over the last 10 years, 15 years. And these are a couple of people that actually talk about the strategy you're talking about here being flawed.
Of course.
That's Susie Orman and Dave Ramsey. Now, these guys jump in there, Dave's touting because he's been broke, been there, bought the shirt, got this and done that.
Yeah.
And Suze, you go and you listen to her stuff and you go, this is such basic junk. This is something grade schoolers should be doing. But she's not really making her money that way. She's really, both of them are making a significant amount of money that have nothing to do, in my opinion. Again, it's just an opinion, but I'm pretty sure I'm probably close to being right, from what they're being paid at OPB or what they're being paid from their radio station to tout this information.
Don't forget endorsements.
Well, that's what I'm talking about. They're being paid other than what they're actually telling you to do.
Exactly.
So that's what I'm getting at. So let's talk about those two characters, because they're not the only ones. Like, for instance, there was a radio show I was listening to, and I don't listen to talk radio very much. But when I do, it's funny at the time what I hear. Now, we had Suzanne Summers come on, and she was talking about her book, Knockout. And it was really, the book was about renegade doctors out there finding ways to basically reverse cancer, treat cancer, and were highly successful at it versus the norm.
Right.
So I'm listening to this doctor on radio, and it was a doctor, I can't remember, but it was his own radio show. And so a lady actually came on and sincerely asked, what do you think about Suzanne Summers' new book, Knockout? This was what he said, and you got to imagine, so the lady must have dismissed it after this. Well, these celebrities, they come along and they basically think they know about everything, so forth and so on, and just dismissed the whole thing. I'm like, you just dismissed the opportunity for somebody to actually begin maybe doing some real homework on this.
Right.
Without even knowing what the book was.
Well,
and so that's where I'm coming from there.
I hear you, and it's very frustrating, Daniel, that, people's minds are closed. They come into things and they think they already know all the answers. They've heard it all before, and they are not open to hearing it. And that's a shame. That's, it's such a shame. And, here's something interesting. When you look at dividend paying whole life insurance, if you go back to the 1950s, our great-grandparents, at that time, 50% of all Americans had these policies. 50%.
Mm-hmm.
It was the most common way that they augmented their pensions. It was the most common way, and that they would use them for financing back then when they wanted to, send a kid to college, or they would use these, or go on a vacation, buy a car. They would use these policies, And a lot of very famous people use them as well. Disneyland would not exist if it were not for the fact that Walt Disney had a policy that he used to finance the beginning and the research for Disneyland. McDonald's, same thing. Ray Kroc, he had borrowed from a policy to start that company. The Pampered Chef started that company out of her living room with a life insurance policy loan. There are so many stories of this. That was so common back then. Nobody even questioned it. But then, of course, stock market investing became the kind of thing that the everyday person started doing, and then they passed the 401ks. Oh, I got to tell you something. I don't know if you know this or not, Daniel, but the man who he's considered the father of the 401k. His name is Ted Benna. He is considered the father of the 401k. And he's also the person that a couple of years ago started saying the 401k has turned into a monster that should be destroyed.
Wow.
And he said that for 3 reasons, and they're basically the reasons you just talked about: the fees, the taxes, and the unpredictability.
Right.
And not only that, just guess where he says he's putting most of his own money today.
Mm-hmm. And exactly what we're
what we're talking about. These supercharged dividend, what I call high cash value, dividend paying whole life policies. That's where he says he now puts most of his money to, because it avoids all of the problems that he believed came up and perverted a good thing that he had started, but Wall Street.
Like all good things, somebody finds a way to take advantage and exploit it, and boom,
of
you're
it,
gone.
and exploit the consumer and rip them off for fees and not give them any guarantees. So there's a lot of proof of that. But I actually, on my website, bankonyourself.com, I have a whole section where I counter one by one the claims that Susie Orman and Dave Ramsey make about why whole life is such a poor thing to be doing with your money.
Now, I'm curious, Pamela, why is it they're motivated to do that? I don't understand if they claim their best interest is in finding ways for people to, avoid the alleged mistakes they've made.
Well, I've had for maybe, 8 or 10 years, I've had a challenge to both of them out there. I'm willing to debate them publicly, and I also have a $100,000 cash reward on my website for someone who says they use a strategy that has more guarantees and advantages than the Bank on Yourself strategy, and that's been out there for years and years too, and no one's been able to claim it because they don't have anything that comes even close. Mm-hmm. But I honestly, I really believe that it's this, because I know for a fact that there are people who know Susie and know Dave, have taken my book, my website, to them and shown them where and how they are wrong. I actually have two of my own policy statements on the website that prove point by point that everything they say about these policies is wrong. Proves it.
Wow.
There's no, you can't question it because it's the proof. Like your the death benefit never stays level. No, that's an old-fashioned kind of policy. Nobody even recommends anymore. These policies grow every single year. The value keeps going up, and here's proof. And another thing that they say is, when you die, the company keeps your cash value. They pay you the death benefit, but they keep your cash value. And isn't that awful? What an awful thing. And I actually show, using my statements on the website, that technically it is true. They do not say, here is your death benefit plus your cash value. However, I demonstrate with my own policies that if I died on the day of that particular policy statement, the company would have paid me an amount equal to my cash value plus the death benefit plus another $14,000. You can't argue that stuff if you've got a policy statement that shows it, that they're
Right.
wrong. They're simply wrong. The problem is that they're talking about a type of policy that was popular, like maybe 30 years ago. And it's not popular today. It hasn't been popular for years. It's not the most common policy out there. But my take, since I do know they know this is out there, I know they know, and they know that I've offered to debate them. Can you imagine everything that would be required for them to have to rewrite all of their stuff and all of their books and everywhere that they've said these things about it that are not true? It turned out.
Well, yeah, that's right out there with the big Shakespeare debate.
Yeah.
That they've actually, and this has been going on for a century or so, the big debate of whether Shakespeare actually really wrote all of the things that they're
Right.
claiming he wrote, and it's a pretty relatively known fact that he in fact didn't. But imagine how that turns. I could see, and the funny thing in all the years I've been in radio is I've started seeing that ugly monster rear its shadow, if you will, where, well, of course, academia is going to keep things going the way they do because they've got too much at stake. And it's the same thing here. They've got too much at stake. So again, what I say to listeners out there is do your homework. You don't have
Right.
to see if these guys are right or if Pamela's right. Just take a look and do your homework. And that's the problem. It's funny how people will spend so much time, looking for the right home and looking for the right car and looking for the best deals in clothes and the best deals on cell phones. I mean, they will research and do homework to death on things that are basically not even assets.
That's right.
And yet they won't spend any time researching how money works, the best ways to work it. Now, what I'd like you to talk about in detail, first of all, what is a dividend-paying insurance policy? And the reason I say this is important is because we're going to be bringing this other guest back on, and he believes in buying dividend-paying stocks.
Okay.
And
So,
he's fascinating because I'm sure he's saying the same thing like you are through the stock market, how you can really almost always gain no matter which way the stock market goes because, like you're saying, you're talking about something that goes back 100-plus years. He's saying the same thing, that you can invest in companies that have been around and have been paying dividends, and that's how you can find that kind of security.
Sure.
They've been doing it for, like, Johnson & Johnson. So even when their stocks go down and you think you're losing money, he says, no, because you're reinvesting those dividends are going to pay you, and now you're buying more stocks. What's going to happen when that stock goes up? You're going to be doing pretty pretty well. He says, you want that stock to go down.
Right. Well, no, that's a great point. How does a dividend-paying whole life policy, compare to, say, and how is it similar or different from dividend-paying stock? And certainly the concept of dividends is somewhat similar. The way whole life policies pay them out is a bit different. The first thing to know is that there are companies that do not pay dividends. We would never recommend using a company that doesn't pay a dividend. When companies,
now, let's talk about real quick, what is a dividend?
Okay, so in the case of a life insurance company, a whole life insurance company that pays dividends, the way it works is the companies set the premiums for each policy. And they set the premium based on a number of factors. They know how long, what they call actuarial science, right? They know how long you're probably going to live, or you have a very good chance of living to this age.
It's where the bean counters come in.
Yeah, that's where the
Anybody
bean
who's seen The Rainmaker
Right.
can understand these things.
Right. So they take that into account. Then they take into account how many policies are we likely to have to pay a death claim on. And a lot of that has to do with the actuary science, And then they're like, okay, so we're going to set our premiums based on that. And each year, at the end of the year, we're going to take in all the premiums, and we're going to look at all the expenses. And if there's something left, then we will pay it out in the form of a dividend on top of the guaranteed cash value that we are guaranteeing every single person who has one of our policies. And because, unlike Wall Street, whole life insurance companies are experts at overpromising. Wall Street's an expert at overpromising. The whole life companies are experts at under-promising and over-delivering. And what that means is that for 160 years, many of these companies have had enough money at the end of the year that they paid out a dividend.
Right, which is the same thing with dividend-paying companies and stocks, that they've got all this money and they figure, well, let's just go ahead and give it, to the people who are invested in our company.
Exactly. In a sense, the people who have policies in what they call a mutual company, those people, as opposed to a stock company. There are stock life insurance companies. Most of those companies do not pay dividends to their if they're owned by stockholders. Their number one priority is to make their stockholders happy. But for the mutual whole life insurance companies, they're essentially owned by the policy owners, and their biggest, that they owe the most, and they want to reward their policy owners. So it's like, the difference between a stock, company and a policy owner-owned company.
Wow, amazing stuff. Now, what about how people, we were talking earlier about IRAs and 401ks and how, people can find themselves in a very vulnerable position. Let's talk about banks, credit card companies, and finance companies, and how moving with this sort of shift in the mirror, if you will, this prism, that we can see things differently when it comes to something like that.
Okay, I'm not quite sure that I understand your question. I'm
sorry.
Okay,
so banks, you borrow money, or you got your mortgage in a bank, or you got a credit card because you need some money, available, that sort of thing,
right.
And finance companies, things like that.
Right. So here's what's really frustrating about banks. There's a couple things interesting there. And when you deposit money, at a bank, you put it in a savings account or a checking account or a money market account. It's been how long since you didn't need a magnifying glass to see the interest that they're paying?
Right.
I can't even remember how long it's been. It's been that long, right? But then what do they do with that money? They turn around and they loan it out for dozens of times more interest than they're giving you. And they're going to make you beg for it, apply for it. They are going to control, you're going to most likely require some sort of collateral. They're going to, if you miss a payment, what happens? You are going to get collection calls. You're going to get black marks on your credit report, which are going to cause you to have to pay higher interest or not even be able to qualify for credit in the future. You could have people, showing up in the middle of the night and hauling your car away or whatever it is. And in many cases, they can close down your loan without notice, like they did during the financial crisis, where people had, home equity lines of credit that they shut down without notice. They said, guess what? You don't have it anymore. It's gone, And the difference between that and using your whole life policy as a source of funding is that you qualify to access anywhere, depending on a number of factors, anywhere between 85 to 90% of your cash value you can access any time for any reason. You can pay it back if you want or not, and you can pay it back at your own schedule. If you miss a payment, well, who cares? You're paying it back to yourself.
Right.
There's no black marks on your report. There's no collection calls. We do tell people, we encourage you to pay back your policy loans unless you're taking it for retirement income, then that would be a different situation. The reason we tell people to do that is that now you're going to have more money for retirement. Mm-hmm. And if you took a loan from a bank, you would expect to pay it back. Otherwise, it's stealing. So if you take out a policy loan and you don't pay the money back, it's like stealing from yourself. Why would you do that?
Right. Amazing.
One other thing about this is very interesting, is that there are a handful, unfortunately there's only a handful of companies that offer this feature. But what it means is when you take a policy loan, you can, of course, pay it back at your own rate, or not pay it back. And there are about 5 or 6 companies that meet all, have all the features that I think are best to have in these policies. So when you take the loan, your policy continues to grow as though you had never touched a dime of it. So if you took a $30,000 loan to buy a car, the plan would pay your guaranteed annual increase every year plus the same dividend as though you hadn't taken that loan.
Wow.
Which is, and I haven't found anything else that works that way.
Mm-hmm. Mm-hmm. Wow. That's, it's all so simple too, so people can go to your website, which is
bankonyourself.com. As you mentioned, I have a couple New York Times best-selling books, but you don't even need to buy them, although we do sell them cheaper than Amazon on the website. Mm-hmm. But we also have a free report, and you can check out those policy statements that I mentioned that prove that Susie Orman and Dave Ramsey don't have a leg to stand on. There's a lot of valuable information on that site, bankonyourself.com, and it's all free.
Mm-hmm. Now, let's go ahead now, and of course there are companies out there that talk about buy term and invest the difference. Mm-hmm. Now, let's go ahead and put those two things side by side and talk about why, again, do your homework.
Right. Yeah, and there have been numerous studies done that show that, first of all, nobody – have you ever met anyone, Daniel? And have your listeners ever met anyone who actually said, you know what, I'm not going to buy this whole life stuff. I'm going to go buy some term insurance, but I'm going to go price how much it would have cost me to buy the same amount of death benefit from a whole life company. And then I'm going to put that every month into my stock market account. There is no such person that has ever done that. So it's a myth. Buy term and invest the difference. The studies show that no one actually does it. What they do is they buy term insurance because it's cheaper, and they spend the difference. So there is no such thing as buying term and investing the difference. But the reason they tell you to do that is the same reason that Susie Orman and Dave Ramsey put down this product, this financial vehicle, and that's because they don't understand it. I'm a woman. I don't mind telling you my age. All right, I'm 65. So I have one term policy, and it's a big one because it was bought, as part of a business arrangement with a business partner, and I looked to see what would happen if I wanted to. It actually, the certain age. Term insurance is pretty young. Every year, term insurance gets more expensive as you age because the company knows they're much closer to having to pay out a claim. So I looked at when this was a 15-year policy that I bought, which means that in year 15, which is coming up, if I want to keep the policy going, I have to pay a premium that is 4,000 times higher than what I've been paying. Now, I could reapply for another policy, but I'm still going to pay a higher rate, and I could only get that policy if I was still healthy. What if I wasn't? Then I may not qualify at any price.
Right.
So what happens? There is other research that shows that 99% of all term policies never pay a claim because the people give them up.
Yeah, no kidding.
Yeah, 99%.
Fascinating.
Is there anything that provides less value than something that you pay for that the likelihood is you will never use? So that's conventional wisdom. You have to, like you say, do your homework, think it through. Don't just, because a lot of people are saying it doesn't make it right.
Amazing stuff, Pamela. Always a pleasure to have you here on the program. And again, the people need to take a look at The Bank on Yourself, A Revolution, which is the title of your book, and you do have other New York Times bestsellers out there. Just take a look and get started. I've done a lot of my own little financial homework, and when I go back, for instance, and you read great investors such as Warren Buffett, you realize, if you just did a little bit of homework, it's amazing just how easy this stuff is to understand and how exciting it is, and how much it makes sense. Get away from the people that are yakking on television or on radio, and that even includes me. I said, get out there and do your homework.
Yes.
Do your homework, and you'll see that it just, when things start to make sense, you're more likely going to do that kind of investing and put your money in those situations there versus how most people invest. Generally, they invest in fear, and and that's no place to invest your money.
Hey, that's brilliant. I really enjoy our interviews, Daniel, and I can see why you have such a strong following. You have a wonderful perspective. You're open-minded. You don't just take the conventional wisdom and close your mind, and that's why your listeners love you.
Well, that's why I love having you, too. So we're certainly going to have you back on again. And, even so, this goes into the YouTube-verse.
Yay.
And so you'll have continuous listeners, that'll be on there, and they post threads, and we talk about stuff, and it's pretty amazing how technology, there's a lot of good stuff out there, too, when it's used well. So.
Absolutely. Well, so glad to hear that. I'll be looking for it, and we'll let people who come to our website know about it, too.
Absolutely. Now, Pamela, for our listeners out there, go ahead and give out your website one more time.
bankonyourself.com. That's bankonyourself.com.
And let that be, for a lot of you, perhaps, the beginning of your homework. Get out there and get that financial education and make better decisions, because just like you and your body and your health, as I've always said, you're your own best doctor. Well, you can be your own best investor as well. All it takes is a little bit of homework and some knowledge, and you're on your way. Pamela, thank you so much for being on the program today.
My pleasure. Have a great day, Daniel.
You too.
Thank you.
We want to thank you, the listeners out there, for joining us. You can also discover more at beyond50radio.com. That is the number 50. We do encourage you to sign up for our weekly e-newsletter to keep up to date with what's going on in the world of Beyond 50, as well as our upcoming shows. I'm Daniel Davis. Thank you for joining us. This is the Beyond 50 radio program. And remember, live your day past halfway.